This video covers Chapter 4, specifically margin. And it's margin on the buying of a security. In other words, when you take a long position, this margin. Another video I'll have is short sales and the margin associated with short sales. So now what is margin? Margin, it's tricky. This language is tricky because when you think, most people think when they hear margin that margin is the amount of money that you borrow to buy stock. And you got to be careful there because margin really represents the equity in your account. So the point is when you sign up the trade on margin with your broker, you're going to open up an account that allows you to borrow money to buy a portion of the stock. However, the portion of the stock, the actual down payment that you make on your own from money out of your own pocket is that's called the margin. It's the equity or the skin in the game that you have in the transaction. And the loan that you get, well, that's just called the margin loan. Okay, it's a borrowing. So be careful with the language. Opening up an account on margin implies you're going to borrow, but the margin is really the equity or the skin in the game you have in the transaction. Okay, before we go further, let's define margin. Margin is calculated as the market value of the asset that you're buying minus the loan that you're going to get divided by the market value of the asset that you're getting. So if you look at this very carefully, this right here, the market value, this is really your assets minus your liabilities. And you know from accounting, that's basically equity. Am I right? That's basically the equity that you have in a transaction. Okay? And so it's the equity divided by the market value of your asset is the margin. So you think of this as your total assets in a sense. Okay? Now, that said, there's two types of margin. There's two forms. One is initial margin. Okay? Initial margin is the down payment that you initially put down on a stock. It's at a minimum 50% in the stock market. The Federal Reserve Bank requires a minimum of 50% down payment on stocks, which means the flip side of that means you can borrow a maximum of 50%. So you need to put a minimum equity down of 50% and you can borrow the rest of it. Okay, now the Fed comes in and steps in. You might ask, why is the Fed involved in this? Fed monitors banks. Well, it used to be in the up and through the 1920s, the roaring 20s, the stock market did great in the 1920s. Basically, almost bubble territory in terms of stock prices. And people started to buy stocks thinking, just expecting, it's basically the greater fool theory that you're going to buy a stock low and somebody's going to come along later and buy it at a higher price. It's called the greater fool theory because you're a fool because you're not looking at the fundamentals and what the stock is really worth. You're just expecting that there's another fool down the pike that'll pay a higher price than you. Nevertheless, this happened in the 1920s, and when in October of 1929, when the stock market crashed, people lost everything they had because in some cases people only put down a couple of pennies per share on a stock, meaning their equity was only a couple of pennies per share, and they borrowed the rest, like 99% of the price they borrowed. And as soon as the stock fell by 1%, you just wiped out all your equity. And if it falls by 5%, you just lost all of your equity plus 4%. So you get it? So what happened was, now it's actually not funny. People actually committed suicide, jumped out of windows because they lost everything they had. They were just too levered up. It's an example of too much leverage. And what happened was people defaulted on their stock borrowings. And the brokers that sold them and lent them the money were borrowing monies from banks. And so individuals went bankrupt. They didn't pay off the broker. The brokers went bankrupt. and the banks were holding the bag as the last resort, but it ended a line, so to speak, and it helped cause a banking collapse. The stock market helped cause a banking collapse. And so the Federal Reserve stepped in and said, when it comes to buying stocks, you have to put at least a 50% minimum down payment. So that's initial margin. It's the initial skin in the game. Okay. The other type of margin is maintenance. Okay. Maintenance margin. Maintenance margin occurs when the market value of the stock falls below a specified minimum. And it's what happens when the stock falls below this minimum, you'll get what's called a house call or a margin call. Okay? It's best illustrated. These concepts are best illustrated with an example. So here's the example. Get a fresh piece of paper. Let's say you buy 100 shares of Apple. And Apple this week is trading at $110 a share. And let's say initial margin is 60%. So what I didn't tell you a minute ago was that while the Fed sets a minimum, a 50% margin requirement, brokerage firms are allowed to actually increase that margin. And so your broker is requiring a 60% down payment, 10% above what the minimum is of 50%. So your broker is allowed to go higher but can't go lower. And your broker, if you read the fine print in the house rules, which when you open up a margin account, by the way, you're going to have to sign an agreement that talks about how the interest rate is calculated and how things work. It's basically what I call the house rules. They're all slightly different from one brokerage firm to the next, and it's very legalistic, and it goes on for pages, and you're going to sign your life away, it feels like. But that's the way margin accounts work. And also what's going to be stated in there is if you can't, what it'll say is, if the stock falls in value, your broker is allowed to sell out your position at any time to cover their borrowings, to protect themselves. They don't even have to notify you. And so you read the fine print, it'll tell you that. Okay? But under normal circumstances, that probably won't happen. Okay, so you read the fine print, and the initial margin requirement is 60%. 60% of the stock has to be paid for. And then the maintenance margin, according to the house rules, is 35%. That means basically your equity can't fall below 35%. If it does, you're going to get a house call, which means you're going to have to kick in more money. And again, you need to resort to the house rules as to exactly how much that money will be. Often we just assume that you need to get your equity back up to 60%, the initial. But read the house rules to make sure that's the case. So now the question is, how much money can you borrow in this situation? How much money can you borrow? And what is your equity in this transaction in dollars? So let's analyze it. Okay. So initial margin is 60%. The value of your stock, the market value, is $11,000. It's 110 times 100 shares is 11,000. The loan is what we're going to solve for. We're going to solve for L. And the value of the asset is 11,000. If you solve for this, cross multiply at 6,000, right? Basically, this is 6.60. People ask me this every semester, but it's basic math. We're dealing with fractions. You can always divide by 1. It doesn't do anything. Cross multiply this with this and this with this, and you basically get 6,600. So 0.6 times 11,000, right, equals 11,000 minus L. And so L equals $4,400. That's the maximum loan you can get. So that's the amount of money that you can borrow. Okay, that means your equity, which is the top part of the fraction of margin, it's the market value of your asset, 11,000 minus what you can borrow. That means your equity is 6,600, which is 60% of the 100 shares at $110. At $110. Sorry about that. So the most you can borrow is you're going to borrow $4,400 from your broker, and the equity that you have to put in, the skin in the game, has to be 66. The total of those two numbers will add up to $11,000 because you have to pay for the stock you bought somehow, some way. Now, it's often the case, depending on, you go to the web, you go to some textbooks will draw T accounts. So you have a T account. Okay, normally when you do a T account, you think of this as a balance sheet type thing. You have assets, you have liabilities, and you have equity. Remember accounting? Yeah. So here you bought an asset that's worth $11,000. That was the market value of your security that you bought, $11,000. That's what you control. You just borrowed $4,400. That's your liability, and you just put in equity of $6,600. So both sides balance. That's why it's called a balance sheet in this simple T account that I have. Okay, all makes sense, right? Now, let's continue. Let's assume now that immediately after you buy the stock, the stock drops from 110. It goes from 110 to $60 a share. Whew! You're taking a beating in the market, right? Stock drops significantly. So now the question is, do you get a house call? Will you get a house call? Well, let's figure out how much margin you have. The stock is now worth $6,000, $60 times 100 shares. Your loan is still there at $4,400 divided by the $6,000 market value. That is 0.267. That's about 27% equity in this position. Whoa, sorry about that. About 26%. It's below the 35 maintenance, right? So now you're getting a house call, HC. You're getting a house call. And your broker is going to ask you to put more money in the account. And so how much, though? So how much? And how much is in dollars, right? Now, you're not going to talk percent because you can't write a check for cents. You got a percent. You need to put it in dollars. And so that's what we're going to do. Now, let's assume your broker wants you to get it up to the initial margin of 60%. So your goal is 60%. You have a market value at this point of $6,000. You have to figure out an NL, a new loan balance at this point. Okay, that's what we're going to solve for. And the market value is $60,000. Now divide this by 1, doesn't do anything. Cross multiply and set them equal. So this is 3,600 equals 6,000 minus the new loan. This is the maximum new loan that you can have. So the maximum new loan is 2,400. Okay. Now let's look at what we have here. The old loan was 4,400. It's what we borrowed a couple of seconds ago before the stock fell. The maximum new loan is 2,400 that your broker is telling you that you can do. The difference is $2,000. That is your house call. That's how much money you're going to have to pay the broker, add to the account to bring the margin back up to 60%. And you can verify that that's the case. So 6,000 minus 2,000 divided by 6,000, that'll give you your 60%. Okay. Now, oops, nope, 24. That'll give you your 60%. Okay, because that's the maximum new loan balance right here. Make sure I got the right numbers. Don't put the house call amount there. This is the amount of money that you're going to pay your broker. Now you can double check this. Make sure you got your head on straight in this stuff. It's easy to get lost. And it's a word of caution at this point. I'll caution you in class and I'll caution you here. Follow the method that I'm doing by using this formula. I'm using the market value minus the loan amount divided by the market value and coming up with equity. I'm not doing a shortcut. I'm going through almost a long way. Some people, you'll just try to jump to a shortcut. But trust me, when the problem gets complicated, you're going to get all tangled up in what's going on. And if you follow the method that I'm doing, the methodical laid out method, you won't get lost in what's going on in the transaction. So that's my advice to you. Take the long way. It's only along by a couple of seconds, but it'll help your train of thought. So now the stock, when it dropped to 60, is worth $6,000. Your new loan is $2,400, and now your equity, has to be $3,600, right? For this to balance, has to be 36. Now, how do we get to 36? Well, we started with 66 in equity, remember, and then we lost $5,000 in capital losses because the stock just fell $50 a share. It went from $100 to $60. It lost $50 a share times 100 shares. So you lost $5,000. That means you lost equity of $5,000. But you also made a house call of $3,000. That money came somewhere out of your pocket or out of a bank account somewhere, but you added it to your brokerage account. Therefore, you got, $3,600 in equity at this point. Everything balances, and you're happy. Now, one more thing before we leave margin. You might ask yourself, well, why do I care about margin? Well, it kind of goes back to the story I was telling you about in the Roaring '20s. People bought on margin, opened up margin accounts, bought on margin so that they're leveraged. They get an extra kick, and when the market works for you and with you, the leverage is great. But when the market works against you, the leverage can kill you. So let me give you a way to try to measure that leverage. And the way we can measure the effects of leverage is by looking at and computing the return you get. And the return that we're worried about here is your net income from the transaction divided by your equity. So you can call this return on equity if you'd like, because that's basically roughly how your return on equity is calculated in this case. So when you were levered up with leverage, meaning you borrowed money on and you went through a margin account, you lost $5,000. That was your net income, right? That was the net income, the net loss, right, from the capital loss from the stock transaction. You lost $5,000. Don't worry about this. This is just margin accounting. Has nothing to do with your capital loss. The $2,000 kick, you just move money from one account to the next here. So you lost $5,000 in net income. In your equity, when you bought on margin, remember, way back at the beginning, way back a couple of pages ago when we first started this, your equity was $6,600 at the beginning, the very first part of this example. And so you lost 83% of your money. And in some cases, you can lose more than 100% of your investment when you're leveraged up. And that's what happens if you only put a few pennies down in equity. It only takes a few pennies of losses on the stock before you lose more than 100% of your equity. Here we lost 83% of our equity, okay, on a leveraged transaction. Had we not been leveraged, no leverage, in other words, we buy the stock outright, 100%, no margin account, no borrowing, then we still would have lost $5,000. There's no getting around that. We lost $5,000 on the transaction. But we would have put down $11,000. We would have spent all our money. We would have paid 100%, 100 shares times $110. Whoa, sorry about that. And so if we were unleveraged, we would have lost about 45%. So the point is, leverage is a double-edged sword, and it's best represented on a graph here. So think of it here as this will be a percent return on your account. This is percent return on this y-axis. And you can say that this, on this axis, the x-axis, is the percentage change in S, the percentage change in the stock price. And so at $110, right, if you buy the stock and the stock stays at 110. So think of this point right here as being $110 where we bought this Apple stock. If the stock stays at 110, your return is going to be 0. You're going to be on this axis right here. Now, you're going to have a line with a slope of 1 if you pay 100% for the stock. No leverage. Okay, no leverage. That means what I'm saying here is, look, if the stock goes up 10% positive, you come up and over, and you're going to be at a positive 10%. Okay, so this is positive 10, this is positive 10. That's the effect of no leverage. If the stock drops 10%, you're going to fall 10% in your return. No leverage means you pay 100% of the stock. You did not borrow you didn't borrow through a margin account. Now, when you borrow and you're leveraged up, your portfolio returns look like this. The relationship between the percentage change in the stock price and the return on the stock moves in this direction as you borrow more and more. And so what happens is, if the stock drops, say, to $50 a share, like we saw, no, to $60 a share, we would lose, according to the math we just did, we would lose 45% right here. Stock goes to 60, we would have lost 45. Okay? Because this is a 45% loss. This would have been a negative 45 here. Because the percentage drop in the stock price was 45, we would have lost 45. But what happened was we lost 83% when we were on leverage. So when the stock fell to 45, we lost 83%. So what happens is the double-edged sword effect is shown nicely in this graph, is that the gains and losses are magnified on a percentage basis when you trade on a margin account. They're magnified significantly, and the slope of this line goes from a slope of 1 when you pay 100% to a steeper slope as the more and more money you borrow and the less equity you put. You get a steeper and steeper and steeper and steeper slope. So that's the effect of leverage in general. That's what happens with leverage. When you borrow money to buy an asset, and that asset does poorly, you're in trouble. If it does well, you're great. You're sitting pretty. So most people, lots of people, they borrow on margin when the market's doing really, really well and the market's on fire like it was in the 1920s. They borrow on margin. But that's the time when bubbles are happening, stock market's overheating. It's probably the time you don't want to be leveraged up. And so you probably don't want to leverage up because you're going to lose. You have the potential to lose a lot. So back in your broker, and you got to read the fine print of your house rules, is allowed to change the margin requirements at any time that you're subject to, and so they can kind of pull the rug out from under you. Back in the late 90s, most of you won't remember this, probably weren't following the market in the late 90s, but in the late 1990s we had a dot-com bubble and the stock market was doing tremendously well with internet stocks. When the internet first was out there, first became popular, internet stocks were doing really, really well. Any stock that had a .com behind it in its name did extraordinarily well. So what happened was they were doing so well that brokerage firms got nervous and they started to ramp up and increase the margin requirements for stocks that had a .com in it or were high-tech or internet related. And that kind of dampened some of the speculative activity that took place in the market at that time. And so that's one way to try to dampen a bubble, or even pop a bubble, so to speak, is to increase the margin requirements. And that happens, occasionally happens with oil and gold. If oil and gold commodities go crazy, margin requirements may pick up a bit.